Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Walmart stock so we can determine if it's a buy or a sell. Walmart operates massive discount retail stores selling almost everything. Its stores have fresh produce, a bakery, deli, dairy products, electronics, clothing, toys, home furnishings, etc. It also owns and operates Sam's Club retail warehouses. It has over 10,000 stores in 24 countries. In the US and Canada, the stores are called Walmart. In Mexico, it is called Walmart de Mexico y Centro America. In India, it is called Flipkart. So if you go to another country, it's probably not called Walmart. They have many names. This company has more employees and more revenue than any other company in the world. Sam Walton was the founder, and his heirs own over 50% of the company. The company is headquartered in Bentonville, Arkansas, and was founded in 1962. Let's get started with the model. This is a large cap company, 412 billion market cap. They're trading at $153 a share, and they have 2.7 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had a ton of free cash flow in 2021 at 26 billion. It dropped a lot to 11 billion in 2022. And in 2023, it went up to 12.2 billion. They completed their 2023 fiscal year because their fiscal year ends January 31st. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's gone down from 15 billion to 11 billion. Revenue is sales for the company, and that's gone up from 520 billion to 610 billion. One company generates 600 billion of annual revenue, and that's more than any other company in the world, including Apple. This is the company's most recent income statement, the 3 months ending 1/31/23 and fiscal year end 2023. In their most recent quarter, they had 162 billion of revenue. That's up from 151 billion in 2022. Total revenue 164 billion. They do make 1.3 billion from memberships. The expenses directly related to generating the revenue, that's 125 billion. Then you have operating SG&A, that's 33 billion. So their operating income is pretty low, only 5.6 billion. They have really low margins. Apple makes a lot more money even though they have less revenue because they have higher margins. They spent 521 million of interest on their debt. So their net income in the most recent quarter is 6.3 billion, up from 3.6 billion. They decreased their shares outstanding. They had 2.77 billion shares outstanding. Now it's down to 2.7 billion. I'll show you a breakdown of their revenue, the 164 billion. A bulk of their revenue is in the US, about 65%, 113 billion in the most recent quarter. 28 billion in international and 21 billion for Sam's Club. Total revenue of 163 billion. They're really successful in the US. When they venture outside the US, they don't really do that well. Let's look at the capital structure. 77 billion of equity, 59 billion of debt. They're 57% equity, 43% debt. Their net debt is 50 billion. So they have about 9 billion of cash on their balance sheet. I gave them a WACC of 8.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 335 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $303 billion. We divide that by 2.7 billion shares. And we get a calculated stock price of 112. They're trading at 153, so they're trading at a 36% premium. It's a sell according to the model. Simply Wall Street has them at 142. They say they're 8% overvalued. 29 analysts priced this stock, and the average price target is 165. The low is 150, the high is 175. 38 analysts priced this stock, and the average price target is 163. They say the stock is 7% undervalued. This is where the stock has been trading since 2002. It is hard to tell on this chart because it's so many years, but there was a really nice run up from 2011 to 2012. It was trading around $75 then, and then in 2015 it got up to close to $90, and then dropped about 35% to $60. 2015 was a rough year for this company. Here's an article from 2015. Walmart is slashing its sales forecast for the year, warning that heavy investments in wages and e-commerce could curb future earnings. This is a great time to pick up the stock. You could have got it at a nice discount. You can see this article mentions the news sent Walmart shares plunging. But Walmart is a great company, and it could have been painful if you owned this stock because it doesn't go up right away. To get back up to where it was before the big drop, it took about 2 years. It sounds like it's no big deal when looking at the chart, but when you live it day by day, it could get pretty painful. But once it got back to about 85, 90, then it shot well past that number. And you could see the stock pretty much only goes up. Even during COVID, it didn't go down too much and ran up real fast. There was that real big drop in 2022. Lots of stocks dropped in the beginning of 2022, but it came right back up. It is trading about 10% below its all-time high. It looks like its all-time high was around 170. In the past 21 years, this stock is up 218%. The S&P 500 is up 260%. But if you go back another 5 or 10 years, this stock easily outperformed the S&P 500. And they always pay a quarterly dividend, and they always raise it each year. It's up to 57 cents a share, a yield of 1.5%, 50% of their free cash flow, 54% of their net income. There are 9 companies in the same industry as Walmart, and if Walmart has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend more than any company on this list in CapEx, $17 billion. They have a good debt to equity ratio, better than the median average. Look at Big Lots. Their stock has come down so much, their yield is up to 14%. But Walmart's yield is larger than the median. They generate a ton of free cash flow, more than every company on this list combined. Their market cap is about equal to the other 8 companies combined. Their price to book is equal to the median. Their PE is worse than the median average. Price to free cash flow better than the median average. Price to sales equal to the median. They generate more revenue than the other 8 companies combined, but their 5-year annual revenue growth rate is worse than most companies on this list. So to summarize, they've been around for 61 years. They're a giant. Not too much risk owning this stock. Could be limited upside. You might want to wait for a good entry point, but you do get your consistent dividend. I have them trading at a 36% premium. I rank their free cash flow as 5 out of 10, their revenue 8 out of 10, and their ratio 6 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to become a member, you can click on the link in the description below. Thanks for watching.